Welcome to the Debt Crisis Problem Podcast, your source for insights into major risk events that could trigger an economic downturn and debt crisis. Today we're discussing another key risk, inflation and stagflation. Our goal is to create risk awareness and spark a healthy debate for the average citizen. The world is too fragile to wait. We need fresh candor and common sense. A debt crisis looms due to unsustainable debt and deficit spending everywhere. It's time to wake up and speak up. Let's get started. Ouch! Inflation hurts. According to the Consumer Price Index, or the CPI, from the U.S. Bureau of Labor Statistics, as of December of 2023, quote, recent history of inflation from 2020 through 2023 shows inflation gaining traction in April of 21 at 4.2%, peaking at 9.1% in June of 2022, and then falling to 3.2% in November of 2023. During this 26-month period, interest rates were raised 15 times, or by 3.25%, to tamp down inflation. Now, what about the root cause of inflation? According to the National Bureau of Economic Research in December of 23, the sharp rise in pace of price increases during the 26-month period was primarily due to the U.S. response to the COVID-19 pandemic and included roughly $5 trillion in U.S. government spending. This contributed to strong consumer and business demand, which tightened labor markets, putting upward pressure on wages and prices, rising commodity prices and supply chain disruptions, rising prices for food and energy, and the crude oil market was disrupted by the Russian invasion of Ukraine in early 2022. Prices still high? In 2023, while the pace of inflation has decreased, according to the stats I just read, many would argue that prices remain high for food and other commodities, with some recent deflationary pricing coming in early 2024. Certainly, the pandemic helped cause supply disruptions and shortages that have led to higher prices for things like gasoline, used cars, lumber, housing, appliances, electronics, meat, fish, dairy, fruits, vegetables, healthcare, labor, housing, education, you name it. Many economists are arguing that unemployment is low and spending is still up, that the economy is strong. Yet many people still see those higher prices and conclude that the economy is bad, and that we're no longer going to have low interest rates and low inflation. The high cost of housing is probably one of the biggest contributors to the cost of living, especially those who are renting. The price of purchasing a place to live has risen so greatly as to becoming a homeowner is hardly a reality for millions. Rents have also surged greatly in the past few years, taking a big bite out of household income and leaving less to spend on other essential products and services. Who is going to ever be satisfied with high prices until there's dramatic reduction in housing costs for the long term? If people must keep paying high prices, there is simply going to be less demand for other goods and services, which may be the reason for any declining prices that are out there. Not necessarily a good thing, right? And so many people are living off unpaid credit cards, where they leave a balance each month. How comfortable do these high prices make you feel? Piecing together the root causes behind recent inflation surge. Loose monetary policies, that pertains to interest rates and money supply. Central banks were credited with averting depression conditions from the 2008 Great Recession and the more recent COVID-19 pandemic. The central banks created trillions of dollars by purchasing U.S. government bonds and assets to keep borrowing costs down and stimulating their economies. To juice the economy, interest rates were kept too low for many years, and thus the potential for inflation was not managed adequately by the Federal Reserve. These quantitative easing, or QE, measures increased the size of the Federal Reserve Bank's balance sheet on a large scale. With inflation growing in early 2021 and peaking in mid-2022. However, the QE measures have since shifted to a tightening posture where securities on their balance sheets are paid off or not refinanced and sold off. Central banks in a higher interest rate environment try to produce a soft landing with just the right level of interest rates and never overdo it and cause a recession. Keep in mind that to reduce inflation, interest rates are increased higher and faster as deemed necessary. They want to sustain economic growth and higher unemployment by slowly adjusting interest rates at the right level and timing. At the present, the Federal Reserve is signaling a slightly lower interest rate environment for 2024, election year, of course. In fact, there was a 50 basis points decrease recently. But overall, interest rates are still much higher than they were before, and for a longer period. We're in the middle of this playing out right now. High interest rates and the world's high debt levels are triggers for a serious economic downturn in the bond, stock, and credit markets. While there's a current bias of eventually lowering interest rates, there are also reasons to consider interest rates also having to increase, especially when the next risk event comes and more untold spending comes. Society's inflation expectations are fickle. Do you really understand inflation yourself? People see that the inflation numbers increase and then decrease, but prices continue to remain high. The rate of price increases is just slowing with the lower inflation numbers. The media likes to sound off on declining inflation, but what does that really mean? Taking the average inflation rate from the stats I read earlier from 21 to 23, you'd have 4.7%, 8.0%, and 4.1% respectively. In other words, if you have a $1 price in 2021 at an average of 4.7% inflation rate, at the beginning of 2022, the higher price starts at $1.05. Not $1, but $1.05. Adding another 8% for the second year pushes the price higher to $1.13 at the end of 2022. Adding another 4.1% inflation for the third year pushes the price higher at $1.18 at the end of 2023. It's cumulative. So there's a cumulative effect going on here. And just because the rate of inflation drops, it only means that the rate of pricing increases is slowing. It's still increasing. The high prices still remain and may slowly come down in some sectors over time. The cumulative effect of inflation means what cost you $1 just 3 years ago is now costing you $1.18. That's an 18% increase in the 3-year period above. If inflation came in at 1%, overall prices would still have risen, even if just by 1%. If you have any inflation going on, overall prices are still increasing accordingly. Low inflation numbers only mean the price increases are happening more slowly. Have your wages kept up with inflation? Hardly likely. Most people like to have annual income merit increases or pay raises that exceed the rate of inflation, or at least match the rate of inflation. And so most people are likely very concerned about the effects of inflation and the state of the economy because their purchasing power is decreasing. As if you didn't already know, now you can understand the reasons why so many people are so very concerned how inflation works. And when it comes down to the stock market, isn't it funny that the very minute the storm clouds get a break, people are quick to pack up a picnic and suddenly everything is okay? For example, they start buying stocks because of the prospect of a lower interest rate environment later in 2024, an election year, and we are quick to get in there with our gambling outfits on and roll the dice to make a few extra bucks in the markets by riding the upward momentum. In short, we can get financially depressed pretty quickly, but get wildly optimistic when the sun comes out and the fundamentals be darned. Honestly, friends, we probably look desperate out there. Is that any way of having peace of mind and to make sound decisions while leaving unwarranted debt on our balance sheets? With those feelings of exuberance that come, are we not forgetting some of the fundamentals and what's even propping up the economy? An unstable and unsustainable foundation of debt? My, are we not fickle? Maybe irresponsible, too, if we have a hefty debt load. Get out of debt fast. This short ad is sponsored by the TunaBudget.com podcast. Hey friends, looking to improve your personal and family financial wellness? Don't miss the Tuna Budget podcast at TunaBudget.com. Download your free Tuna Budget Worksheet Plan, the most powerful budget worksheet plan in the world, yours. In addition, dozens of Tuna Budget's human-side candid conversation memos may be the perfect answers you're looking for. Join us for real candid conversations and candid questions that can change your life for the better. Subscribe to the TunaBudget.com podcasts and empower yourself to take charge of your future and your financial well-being. In conclusion, so what, when, and how does this risk affect you? In the 2020 through the 2023 period, inflation gained traction at 4.2% in April of 2021, increasing to 9.1% in June of 2022, and falling to 3.4% in December of 2023. Interest rates were increased 15 times during this period to bring down inflation. Looking back, it's obvious what helped cause the recent surge in inflation. In response to the COVID-19 pandemic, the U.S. government spent roughly $5 trillion, which contributed to strong economic demand in a period of supply chain disruptions. This and the tight labor markets created upward pressure on wages and prices along with other events. These events and the resultant deficit spending were precisely the reason why it's reasonable to assume we haven't seen the last of it. There will be more risk events, right? More deficit spending, and the debt spiral will have to continue. It's past the point of no return, way past, and a debt crisis is already baked in at this point. $35 trillion in debt, record levels of consumer and other debt, and what do you think is going to happen? When the next event comes from any of the 20 risk events in the debt crisis problem, what will happen if society's expectations of increasing long-term inflation increased dramatically and sharply? While the sun always comes out, the point is that same sun is always going to create new supercell storm events too. We haven't adequately prepared our budgets. Our houses are not all in order. We don't have enough dry powder for these supercells. We're just soaked up to our noses in debt as a country and society. To remedy all these risk events and storms, it seems, is to make sure no one suffers, that we spend whatever it takes regardless of the cost, and just pass it on to the next generation, right? And when long-term inflation expectations do increase, the Federal Reserve Bank's reaction is going to be brutal. How much higher would interest rates go, and for how long would they stay high? Think of all the ramifications. Perhaps this is why no one wants to talk candidly about this risk and other risks that are in the debt crisis problem, with $35 trillion debt load ball and chain being dragged around behind us. It's hard to swim away from the sharks with that big a ball of chain. You get the picture. Because if everyone becomes aware of how unsustainable our debt risk is and talked about it, it might be a game changer in and of itself. When the next event or events take place, many more people will start to realize the U.S. government will just spend trillions more, and we'd likely see more heavy inflation or stagflation, where we throw in higher unemployment too. Meanwhile, there will be breaks between these financial storms, but breaks in the storm does not mean that the debt levels or high prices just disappear. It's just that, a break. We will be facing and having to deal with the fallout of these risk events because that's just the way life is nowadays. You can bet on it. The U.S. government, businesses, and households have not, in my opinion, even addressed or otherwise made enough efforts to be sufficiently prepared for these risk events. Rather, the solution has always been to increase more and more record debt levels. These levels are now so high that they can't be sufficiently be repaid at this point. We've spent our dry powder, used up our credit limits, and now have a real debt repayment problem. In a debt crisis, most of the debts we owe won't be repaid in full, but will be in default and have to be restructured. We will see additional surges in inflation again and again. The day of reckoning is real, and it is coming. Risk events will continue, and it will be harder because the higher and further the plane flies past the point of no return, the higher and further the plane must fall. The resultant damage done by not addressing deficit spending at the consumer, business, and U.S. government levels, the resultant inflation, the more painful it will be for everyone. It just comes to show you that the world is addicted to deficit spending, and with any such addictions will surely come a very painful and long-term recovery. We are all responsible for this mess. I firmly believe that the debt crisis will start to happen somewhere in 2025 and beyond. Can you smell a debt crisis yet? Thank you for joining us. Today we explored inflation and stagflation, a major risk contributing to the looming debt crisis. We hope to highlight the urgent need for transparency around these risks. We want to hear from you. Submit your own debt crisis memo and share your thoughts at tunabudget.com. If you found today's episode valuable, please subscribe for future podcasts. Your support helps us grow this healthy debate. Until next time, take all necessary precautions. Your financial wellness matters. Thanks again.